I always wondered to myself, is there something that helps the entrepreneurs that succeed that they have which other entrepreneurs don't? Is it something they know? Is it how they run their businesses? Is it the people they hire? Is it where they went to school? Is it their socialization, their background, their education, their mental spaces? What is it that makes the entrepreneur succeed? Welcome to my masterclasses, where I share with you everything you need to know about how to become a high-growth, high-scale entrepreneur. I'm joined by guests. We break down the myths, the ideas, the legends, everything you need to know to become a high-growth entrepreneur. Warning, this is the High Performance Zone. Hi, Sam.
Hi.
Gunjan.
Yeah, Gunjan.
Right. For the benefit of everybody, tell them what you do.
Hi guys, I'm a health and wellness coach and a personal trainer. I run a corporate health and wellness. We focus on corporate health and wellness there, and then I do one-on-ones as well.
Right.
Personal training sessions.
Right. Which do you enjoy more, the one-on-ones or the corporate work?
Actually both, because I always make an impact on both elements.
Which do you enjoy more, one-on-one or corporate?
One-on-one.
Right. Which one makes you more money, one-on-one or corporate?
Corporate.
Right. So which in your business do you want to grow, one-on-one or corporate?
Corporate.
Right. So let's imagine I'm a corporate buyer, yeah? How do you price your business?
Per hour.
Per hour?
And your hour we spend at the organization.
Right. And what is the cost per hour?
2.5.
2,500?
Yeah.
Right. Remember I said earlier that great entrepreneurs always measure revenue per hour? Yeah. Great business people never sell per hour. It's like the hardest thing to do. This thing about time. Do you know why? I'm going to tell you why. Because the minute you say to me 2,500 Rand an hour, if I'm your buyer, where my head goes is, but do I make 2,500 an hour? And if I don't, so I charge about 110,000 Rand an hour to speak. How much time have we spent here? I'm sending all of you an invoice. So I charge about 110,000 Rand an hour to speak, but my clients don't make 110,000 Rand an hour. So what I've had to figure out is, how do I make the conversation about value by the time they get to price, it doesn't matter. Is that fair? So up front, what I want to do is I want to over-communicate value up front. Over-communicate value, over-communicate differentiation. Yeah. So if you go to my website, what do? Over-communicate differentiation. I haven't sold you product yet. Over-communicate differentiation. I tell you about me, what's amazing about me, what's fantastic about me, what makes me different. I've got to communicate differentiation so much that by the time you look at anyone else, you go, just go back to the other guy. Yeah? You haven't even looked at price yet. Then when you get to price, you go, okay. But this is kind of the reason why, I don't know if you've noticed, and I want you guys to see this as a great trick. Second-hand car dealerships, when they advertise the car, when they usually park it there, have you seen how they write or they have the price on the windscreen? Yeah? Then I want you to go to a premium dealer. Go to Porsche, go to Bentley, go to Rolls-Royce, go to Lamborghini, go to Maserati, go to Aston Martin. Never price on the windscreen. How come? How come there's never price on the windscreen?
They know the value.
They know the value, right? Yeah. And what they want you to do is they want you to come in and feel it, touch it, taste it. So they over-communicate value up front, oversell differentiation. Listen, if you've been, I promise you now, if you get into an Aventador, the minute that V12 roars, the fact that it costs 10 million doesn't matter. It's like, you're just like, yeah, no, definitely 10 million. Yeah, no, definitely. Okay, so can we simulate a sale, you and I?
Sure.
Okay, so I'm coming to buy from you. Right. Hi, Sam.
Hi.
So I have a couple of fat people that work for me. It's not true, guys. It's not true. How can you help me?
So they're fat.
Yes.
That's it. Is that the only issue for you?
Yeah, I mean, they come to work, they're overweight, they're lethargic. You know, they're not passionate about their work, they complain, there's high absenteeism, they take sick leave all the time. Yeah, it's a mess.
So you're saying they're not productive, they're not energetic,
Yes.
and they're not making you the amount of money they should be making you an hour.
Yeah, exactly. You know, it's just like, I don't understand. I just feel like I should just get rid of them and just go hire thin people. Like I just.
How will that impact your business if you go and hire thin people?
I didn't hire them fat. They were thin when they started. Then I started paying them so that they got fat.
How will that can impact your business. Firing them and getting new people on board.
Yeah, exactly. The thing is, if I fire them, then I've got to get new people on board. I've got to go through the whole recruitment process. Then I go through the slug of the recruitment process. Now they're in the business. Then I've got to train them up. I've got to hope that they meet the culture of the firm. Then I've got to introduce them to new customers.
Okay.
It's a mess.
So what if I told you I've got a solution for you?
I would be interested. How much is the solution?
Well, what if I told you that I can come through, firstly, every single week, twice a week, sit down with them, have a conversation.
Will they lose weight?
Listen.
Okay.
And we align them with personal goals. Because the reality is, it's not about work, it's about their personal lives. So we need to have that one-on-one with them and then take it to a point where you want to go.
Sounds great. Sounds great. So I've got a budget for this. I mean, I don't know if it's doable, but my budget is like 8,000 Rand a month. Is that possible? I've got like 20 people that work.
3,000 Rand a month.
8,000, but it's 20 people.
Okay? And if I told you that I could change the situation, turn it around, what are you looking at putting a value on that?
I just don't know how much, Look, so my budget, I discussed it with my CFO, and he said to us we can afford to spend 8,000 Rand a month, and I can't go above it. That's the budget he gave me. Unfortunately.
I'll ask you again. What do you mean to make a full turnaround on the situation?
I buy it. I'm in. I think it's, look, I'd give you more if I could, but I can't give you. I just, maybe why don't we do this? Why don't you come in and do it at 8,000 Rand a month, and after 3 months we can review, and then we'll see if we can pay you more.
Okay, I say let's do it for a month. I can give you results within a month, and we take it from there.
Okay, cool. Are we cool? Yeah. Right, can we reverse this? Can we analyze it? Yeah. Okay, now, a bit more complex than this experience, but notice how I shifted power. Yeah. Do you see how I did that? Yeah? So the minute I recognized that she recognized my sales technique, what do then? I defer responsibility. So I buy it, but guys do this when they buy cars. Guys are funny. They walk into a dealership, he knows he can't afford this thing. He knows, he's looking at this M4, he can't afford it, he knows. So he looks, he kicks the tires. By the way, that's how you know someone can't afford it. The minute they kick he kicks the tires, he gets in the car, he feels it, the salesman starts talking to him, and start to get a feel for it. He knows he can't afford it. He has one scapegoat. What is a scapegoat? Wife! You got it! He's gonna go, hey, yeah, I love it, Ish, but I must discuss with my wife. He's going to defer responsibility. If you are, and that's why I wanted to use Sam, if you're doing corporate sales, people will always defer responsibility. Okay? So here's what you got to figure out. What you got to figure out when you're selling to someone who's going to defer responsibility up front, as you did correctly. Over-communicate value. The second thing you got to do is you then got to develop collateral to develop internal salespeople in your client's firm. Here's what that means. I'll use my business. In my business, the people that book me aren't the people that pay me. The people that pay me aren't the people that make the decision to book me. I'm going to explain it again. So in my business, the person who calls my office and inquires and says, we have a conference coming up, is usually a person in middle management, marketing, HR. That's the person who goes, there's a conference coming. Marketing and HR doesn't process checks. Finance does. But at what I charge, they don't have the limit of authority to make that decision. I can tell you now. The decision gets deferred up to the boss. So what I've had to figure out is how do I make them my salespeople without me being in the room? Does this make any sense? So my entire pitch, all my sales collateral, is designed in a way that when they come to my office and they go, this is what we need, first thing we do, over-communicate value. That's always the first step in every single sales conversation. Over-communicate, over-communicate, over-communicate value. Not price, value. Yeah? Okay? So it's about, this is the product, this is what it's going to do for you, and this is the difference it's going to make in your organization. Always over-communicate value. Got it? Now when I've over-communicated value, I then switch. And then I say, these are the products, and I summarize it for them, and I give them the information. Because I know the person I'm dealing with doesn't make the call. So why do I want them to make the call in the meeting? They don't make the call. Okay, so I'm going to give you all the information you need. If you go to my website right now, you'll find all of my keynotes are summarized on the website. Why? Because when it gets to that point, my office simply sends you a link and says, go here, click here, and all of our keynotes are summarized. All of them. I have a one-pager for every single keynote. Why? Because the decision maker who makes the call doesn't have more time than to read one page about me and the product. But my products take 3 to 6 months to develop, so I've got to go through a process of summarizing everything to a single page. Then I give it to you. Yeah? So internal, marketing, HR, who's making the recommendation, walks into the CEO's office and they go, there's Vusi, what's your name?
Lukman.
Hey?
Lukman.
And Lukman. Vusi is good looking, but there's Lukman. Vusi is good, and there's Lukman. Vusi charges 110,000, Lukman is 20. The finance guy goes, 20. Now, at that objection, I need them to go, but wait. This is Vusi's material. Switch it to I'm not in the room. I've got to get them to do it for me. Yeah? For those of you who follow, you would have seen recently, we started taking all my keynotes and we're breaking them up into 60-second bits and we're posting all of them on YouTube. Because I realized something. I get booked on YouTube. I don't get booked when they call the office. By the time they call the office, the sale is done. So why don't I serve them as much of the information as possible? The CEO who makes the decision doesn't have more than 60 seconds to watch something. So the HR manager goes, just watch here, watch what he says here. It's on the phone. It's like, watch. And then the CEO's like, wait, watch here, watch. So it's like, okay, get him. CEOs make strategy decisions. They don't make tactical decisions. So when a CEO sees the work I do, he goes, strategically, this guy's worth whatever he charges. Pay him. When the time gets to CFO, it doesn't matter now. Just process the check, chief. Please. No, but the budget, process the check. Okay? So shift, always shift. And I promise you, it doesn't happen to you where they defer responsibility and they say so-and-so has to make the decision all the time? Yeah. So now what you've got to figure out is, what is your leave behind? So when you go into the meeting, you need a leave behind. The leave behind is a document that you leave with them, something you leave on their table. Your competitors don't leave the same thing. You leave it there, and every single time in your absence, that leave behind is a document that speaks for you. Yeah? A leave behind should always be A4, one A4 document. It summarizes everything. In a leave behind, you communicate value, don't communicate product. So in a leave behind about I love using cars, I suppose, because I love them, but a leave behind about a vehicle won't have a spec sheet. A leave behind about a watch won't have a spec sheet. If Rolex or Hublot or Montblanc or Audemars Piguet gives you a leave behind, an A4 document about the watch, I promise you now, it's not going to have anything to do with the technical spec of the watch. It's going to have everything to do with the brand and the brand association of the watch. They're going to tell you about who wears it, how they feel when they're wearing it. They're going to tell you about what it means to be associated with that brand. That's the leave behind. In your absence, it speaks for you. So by the time they call you back, now what you know is you've qualified the sale because you've got a customer that's willing to buy. Yeah? You know that they're interested and they understand the value. Now it's not a price conversation. Never, ever drop price. Yeah. Always talk value. And then the last thing I want to do, did you see the part? Where I said to you, so can we trial it? Yeah? It's the biggest trap corporates do to small businesses. They say, look, let's try. Yeah? Let's try it. You are so hungry for business. The phone isn't ringing, no one's calling, money's not coming in. You go, okay, let's try it. At a reduced fee. Never, ever try it at a reduced fee. Never. You know what you'd rather do? Do it for free. And then at the end of the month, I used to do this. Do it for free, and at the end of the month, send them a notional invoice. He laughs. It's smart, isn't it? The hip hop heads with not notional invoices. You guys see the fight that Drake had with Pusha T?
Yes.
Yeah. What did Drake do when he replied to Pusha T? He sent him an invoice. He said, because now you're attacking me, nobody knew who you were, now they know who you are, I'm going to send you an invoice for marketing. And he sent him an invoice. And then he published it on Twitter. He's like, now, here's an invoice for 100,000. Thank you very much. So what you do is you go, no, man, here's an invoice. I hear you, and I know this is important for you, but I tell you what I'm going to do. I'm going to come in up front. I'm going to do an assessment of all of your people, the strategic ones. I want to tell you the level they're performing at now. I might include some sort of psychometric psychoanalysis. At the end of it, I'm going to give you a detailed report about the issues your people are facing and where they are right now. I'm just going to do the analysis. In other words, I'm going to overstate the problem that you've identified. And I'm going to give you that report for free. That report usually costs 50,000 Rand. Yeah? So I'm going to send you the report, but because I have to dedicate man hours to it, I'm going to send you the report with an invoice, and I'm going to invoice you the full fee, and I'll discount the full fee. So what does Vusi get? He now gets a report of all his people and an invoice that says 50,000 Rand, discount 50,000 Rand. In his mind, it never escapes his mind that this thing was worth 50,000. Now you sit back and you wait. Because if you say, I charge 50, but I'm willing to take 25, Vusi now starts going, this thing is worth 25. After 3 months, when you come back, Vusi goes, no, but you know, I don't have more money. It has a trick to get you in. Don't reduce price. It's a trick, it's a trick, it's a trick, it's a trick, it's a trick. Are we still getting value? Yes? Yes? Cool. I have to finish this. Okay. Cost of goods sold, gross profit. After you charge your gross profit, you pay for these things called SGA, sales, general and admin expenses. Sales, general and admin expenses. So these would be rent, salaries, and all the other stuff. At the end of this, you get to a little item called EBITDA. Am I right? Accountant friend? Did I do this correctly? Yeah? Who knows what this means? For the benefit of everyone here, tell us. You do, sir? At the back? Do you? Yeah? My man, earnings before interest, tax, depreciation, and amortization. What is the difference, sir, between earnings and profit?
Well, earnings.
Dololo. Remember the accountants who charge you revenue, turnover, and share and sales? Are the same accountants when they get here, they say, well, the headline earnings, it's a profit. Earnings and profit, it's interchangeable terms. Okay? So what this tells you is now that you've run your business, by the way, you know what you've paid here? You've paid rent, you've paid your staff salaries, you've paid for printing paper, you've paid for telephone expenses, all of what we call the OPEX of running your business, the operating expenses. You've paid them. This line tells you this is what you have made, but you haven't paid back the bank interest. You haven't paid back SARS, tax. And those assets you bought, you haven't depreciated them. And if you have any intellectual assets, you haven't amortized them. The difference between depreciation and amortization is depreciation is for physical assets, amortization is for intellectual assets. So Google doesn't have many depreciation items, but they run their entire business of the most advanced tech platform, so they amortize it every year. It's an intellectual asset. You can't, it's not a building. Make sense? Right. Of these, which do you pay first? Say again? That was a trick question. Because what you actually do, our good friend the accountant will tell us, is what? You remove which items?
You remove your...
DNA? Yeah. So you take out D and A. You remove your depreciation and amortization expense. These are something called, guys, non-cash items. In other words, if you depreciate an item, there's no money leaving the bank. That's why when you do your statement of comprehensive income, you add back depreciation and amortization, because it's not money leaving. But you and I know if I buy a car at the beginning of the year, okay, say I'm Sam and I buy a car for my business, and I use this car to travel around, that car I will buy from the bank. Ne? So the bank's going to give me a loan to buy the car, which means the loan carries a little thing called interest. On my balance sheet, I must recognize the car as an asset. Yeah? But I pay over the car in 5 years. I'm going to show you why that's important in a minute. So I pay over the car in 5 years. Yeah? But every year, this car is becoming worth less and less and less. So every year I must depreciate this car for what it's worth less of. So I remove it. But it's not money leaving the bank. It's just me depreciating it. Yeah? Then we get to this thing called EBIT. Earnings before? Interest and tax. Now what do I pay first? Interest or tax? Do I pay interest? Who agrees? You do. She says I do. So I pay interest. Then I have something called profit before tax. Here's how I know earnings and profit is the same thing. Because it was earnings, then it was earnings, now it's profit. It's the same thing. Profit before tax. Could you tell us, for the benefit of those of us here who are not quite as studious as you, Mal, why do I pay interest before I pay tax?
Because tax includes everything. I mean, after you pay everything,
Yes.
tax will just stay.
Yeah, but why would SARS let me pay them after I've paid ABSA? Here's why this is important. I'm telling you why this is important. And then I want you to think about your answer. This is important because this is important because at every other law, including the Companies Act, SARS is the creditor, is the superior creditor. It's the creditor of first preference. In other words, if you don't pay SARS, they will come into your account and they'll take the money. Some of you here have had it. You're like, wait, make me 100,000. And then, I shy, yonke. Yeah? Why would SARS do that? Because they know that money must pay salaries, must pay staff. So at every other time, SARS will take the money first. Even, did you know, in the process of liquidation, SARS, yeah, is the preferred debt, is the preferred creditor. It's the place where the money goes first. Now, why on the income statement does SARS say you can pay me after? Okay?
It's a deduction.
Why? This is so important.
Because it's an expense to the business.
Why?
To make commission. Because it helps you make money.
Why?
Makes commission. Because SARS gets tax from the banks as well. To get profit.
Don't they collect it back?
Wait.
No!
Interest.
It's because governments want you to take debt so that you can buy assets, so that you can service more customers, so that you can grow your sales, so that they can get higher tax.
Oh yes, true.
It's a stimulus package. I will take my standing ovation now. Yeah, make sense? Do you know where this comes from? Let me show off a bit. You guys know what happened in 1929?
Yeah.
Yeah, the world went through a crash. It was called Black Monday, the Great Depression. Before then, you always paid tax before you paid interest. And the governments of the day needed to figure out how did they get companies to invest their money. So they said, well, tell you what you do. If you go to the bank and you borrow money, we'll allow you to take away the interest portion of the money you borrowed from your tax payment as a form of stimulus. So that if you borrow money, what do you do with it? Well, you borrow money, you build more factories, you hire more people to work in factories. More factories and more people working in factories means there's higher employment. Higher employment means there's higher taxes means there's a growing economy. Okay? I need to finish this. So, you pay back interest, payment before tax. Then you pay tax, yes?
Yeah.
And then you're left with profit after
interest.
tax. Can you tell us what happens after you with profit after tax? What do you do now? Hey?
I don't know.
Nothing. That's it.
That's right.
Oh, say?
Oh, you
Say
need
again?
to.
Divvies. You pay divvies. What else do you do? Say again?
I think it's a budget.
Budget for the following year. What's the accounting term for it?
Rolling over.
Retained earnings.
Retained earnings.
Right. Let's park here for a minute. If you don't follow, my brother, you look so confused. Are you okay? Are you sure? I'm with you now. I'm with you in spirit. We gotta be one. That's why I say there's such thing as a city. It's so important that you get this. The minute you get this, it's gonna fundamentally shift how you see the JNB Met. It's gonna shift whether or not you decide to go to the Vodacom July. If we accept that a business is a tool for wealth creation, then I accept that creating wealth comes from dividends, not salaries. Johan Rupert doesn't get paid a salary by the companies he holds, he earns a dividends. Okay? I'm going to show you something now. This is just very quickly, very quickly. Okay? This is how you know which stage of your life you're at. When you start measuring what you earn. Yeah? People who earn wages earn weekly, they earn on a fortnight, and they do manual labor. That's why it's called a wage. When you graduate and they give you a full-time job, you start earning a salary, they give you a pay slip. When you graduate from having a salary and you become a shareholder, they start paying you in dividends. When you become the shareholder of the company that is the shareholder in companies, you start measuring in IRR. You can always tell the people's level of wealth by what language they speak. And it's not wrong, you just got to figure out who you're talking to. If the people you're talking to, if your customers are managers, then go talk to them. But I'm at the level now where I talk to the people who own the business. The manager gets an instruction. It's a phone call on a Monday. Do this. He doesn't get to phone me and negotiate price. That's not his job. His job is to do what he was told to do. I talk to managers. I talk to owners. I don't talk to managers. Hey, Bazalwan, we're together. Very nice. I like how we are growing together. We're learning. It's very, very important. Right. I know there are a couple of questions. I'm really cognizant of time. So before I move on, I just have one or two more points to make. See this thing called interest, right? So the interest, would you agree, is a charge you pay for an asset you bought to grow turnover. Please, if you don't understand that, say so. The interest you pay, you don't understand it. Okay, so everything here is the money we make and the cost to make the money we make. Do we agree?
Yeah.
We also agree that the reason the government says you can deduct your interest before you pay them tax is because they want you to take your interest to grow your business so you can pay more tax. So the interest is the charge you pay for the assets you buy to grow your business. This makes sense? This is why you shouldn't technically be buying personal assets in the business's name. Because those don't grow the business.
King